Imagine you're walking down the street, right, and you see someone sprinting past you at absolute top speed. I mean, they are completely red in the face, arms pumping, just fully exerting themselves.
Yeah, you probably think, wow, they are really dedicated.
Exactly. Your first thought might be like, wow, look at them go. They must be training for a marathon. What incredible ambition. But then you look a little further down the street and you realize they aren't chasing a finish line at all. They're actually running away from a bear.
Right, which completely changes how you view their speed. I mean, it's no longer a story of ambition. It's a story of survival.
Yes. And that optical illusion mistaking panic for ambition is exactly what we are falling for right now when we look at big tech. So, welcome to the deep dive. Today, our mission is to dissect a fascinating new article by AI thought leader Johann Stein titled "The Trillion-Dollar Tech Companies Are Afraid." That should tell you something.
It's such a compelling piece.
It really is. Because, the dominant narrative hitting your newsfeed every single day is that big tech is pouring historic amounts of money into AI because they see the future clearly, and they are confidently racing to own it. But Stan's article proposes a counter narrative. What if this isn't ambition at all? What if what we are watching is actually controlled panic?
And understanding that distinction is absolutely critical for you, whether you are a business leader, an entrepreneur, or just someone trying to navigate the digital economy. We've collectively operated under the assumption that these tech giants like Google, Microsoft, Meta, Amazon are the permanent, unshakable infrastructure of the modern world.
Right, the bedrock.
Exactly. But if Stan's analysis is correct, that massive infrastructure might actually be standing on very shaky ground.
Okay, let's unpack this. Before we can even get into the psychology of this fear-driving big tech, we really have to look at the staggering financial reality of what they're actually spending, because the numbers are almost hard to comprehend.
Though they are completely unprecedented.
We're looking at projections for the year 2026. Amazon is committing $200 billion. Google is projecting between $175 billion and $185 billion. Meta has outlined $115 billion to $135 billion. And Microsoft is pointing to an annualized run rate of around $145 billion.
Which is just staggering. When you put it all together, it means these four hyperscalers are on course to spend nearly $700 billion combined on AI infrastructure in a single year.
$700 billion. And this isn't just a gradual expected increase, right? The article highlights that this represents a 67% spike from the already historic levels we saw in 2025.
Yeah, it's the largest single-year capital expenditure surge in the history of the technology industry.
But here's the wild contradiction in the sources. None of these companies can actually demonstrate a positive return on investment from all this AI infrastructure at scale. It's like draining your bank account to build the biggest, most expensive mansion on the block without actually having a job to pay the mortgage.
What's fascinating here is the immediate financial fallout of that cash burn. I mean, this isn't free money they are playing with. Amazon is projected to actually go free cash flow negative in 2026.
Wow.
Yeah, going negative means the cash coming in from your actual business operations is no longer enough to cover the cash you are spending on this infrastructure.
You're literally bleeding money.
You're bleeding money. And it's not just Amazon. Barclays estimates that Meta's free cash flow is going to drop by almost 90%.
Wait, 90%? That's insane.
It is. And Microsoft's free cash flow is forecast to slide by 28%. They are willingly taking massive historic financial hits. The source material brings in an excellent analogy from a UC Berkeley economist that explains the mechanism behind this behavior. He compares what is happening right now to the 1990s browser wars.
Oh, right. Microsoft and Netscape.
Exactly. Back then, Microsoft spent heavily to build Internet Explorer and then just gave it away for free to crush Netscape. Burning cash like this at a scale that turns your free cash flow negative is not a profit-seeking investment. It is defensive insurance.
So they weren't trying to make money off Internet Explorer. They were just trying to protect their existing Windows empire.
Precisely. It's not the behavior of a secure company. It's the behavior of a company that feels compelled to build these capabilities just to avoid being left behind.
So if burning $700 billion is a defensive move, if they are running from a bear, like we talked about earlier, we have to ask, what exactly is the bear? What is threatening their historically locked competitive position?
Well, to understand the threat, we have to look at what made them untouchable in the first place. For 2 decades, big tech's supremacy relied on 4 pillars: proprietary data, massive infrastructure, network effects, and a monopoly on talent.
Okay.
Today, according to Stan, all four are under simultaneous pressure.
Wait, I have to push back slightly here. Don't Google and Meta still hold all the cards with their massive switch data and social graphs? I mean, how is that shrinking?
It's a fair question, but the source material reveals something huge about how AI models actually learn. AI models trained on the public internet are now matching those built on closed data sets.
Oh, really?
Yeah, the infrastructure advantage is also commoditizing as cloud competition drives down compute costs. Anyone can rent the power now. And that talent monopoly, it's fractured.
Wha-
Top-tier researchers are leaving big tech's golden handcuffs to start independent teams.
Because they can just rent the tools they need.
Exactly. If we connect this to the bigger picture, you start to see that money can't fix a broken structural advantage.
So if anyone can rent the compute and the talent is walking out the door, this directly fuels the biggest existential threat of all, the rapid rise of open source AI.
Absolutely.
We actually have the receipts for this. Back in May 2023, an internal Google document leaked, and the memo stated, quote, "We have no moat, and neither does OpenAI."
It's such a stunning admission from inside the castle. That memo correctly predicted that open source communities would develop capabilities faster than closed labs.
And they were totally right. Here's where it gets really interesting. Let's look at DeepSeek's R1 model from January 2025. According to the article, this open source model matched OpenAI's most advanced reasoning models and the training cost, just $5.6 million.
Which is basically pocket change in Silicon Valley.
Right. So if a non-Silicon Valley team can achieve world-class AI for $5.6 million, doesn't the entire multi-billion-dollar business model of selling AI access via API just evaporate overnight?
It completely evaporates. Think about it. When equivalent intelligence can run on local hardware for free, Microsoft and Google's massive bets on proprietary models face an almost impossible path to ROI.
Because why would a hospital or a law firm pay Microsoft a premium to send their private data over the internet when they can just run a free model locally?
Precisely. They just fine-tune it locally. The assumption that superior AI requires Silicon Valley budgets has been entirely invalidated.
So, when a trillion-dollar company realizes its core business model could be disrupted by a $5.6 million open source project, how do they react? The answer is controlled panic disguised as PR.
Narrative management, basically.
Yes, the corporate behavioral shifts noted in the source are wild. Non-AI projects are being shuttered, safety teams are restructured, or completely disbanded.
Yeah, there's a sudden return to the move fast philosophy by companies that spend years claiming to be responsible stewards of tech.
The hypocrisy is glaring. Look at the OpenAI example in the sources. They released a 13-page policy paper comparing their vision to the New Deal in the exact same week. The New Yorker published an investigation into Sam Altman's trustworthiness.
Oh, the timing on that is just incredible.
Right. I mean, a company that is genuinely winning doesn't need a 13-page manifesto demanding your trust.
This raises an important question. Are we watching innovation or are we watching desperation? What we're seeing from big tech is not the consolidation of a winning position, but frantic narrative management under intense pressure.
So what does this all mean? If big tech is scrambling to manage the narrative while burning cash out of fear, what does this mean for businesses and individuals like you, the listener, trying to figure out their own AI strategy?
Johann Stein has a specific warning to South African executives, but honestly, it applies perfectly to anyone, anywhere. Do not read these investment figures as a signal of where to follow.
Because aligning with these leaders assumes they are on solid ground.
Exactly. And they aren't.
So if you are building an AI strategy or a startup, relying entirely on these massive platforms might be building on a narrative rather than reality.
But that creates immense opportunity. The barriers to entry are lower than they have been in 20 years. Small teams with superior ideas can now realistically challenge trillion-dollar incumbents.
Because the decentralization of AI is real.
It is very real. And the window of strategic opportunity for smaller organizations or emerging markets is open right now, but it won't stay open forever.
Wow. So to summarize, the true meaning behind this $700 billion spending spree is clear. It's not a confident race to own the future, but a frantic, defensive effort to rebuild broken moats by institutions that are genuinely afraid of what is coming.
They are terrified. Though, to be fair, big tech still has formidable resources and distribution. We shouldn't write them off. But I'll leave you with a final provocative thought to ponder.
Let's hear it.
If these tech giants are currently spending $700 billion out of fear of decentralized open source competitors, What happens when they realize that money alone cannot buy back the control they've already lost? Will they pivot from outspending the open source community to trying to regulate it out of existence?
If you can't beat them, make them illegal. That is a heavy thought, but such an important one. Thank you so much for joining us on this deep dive. We hope this empowers you to keep questioning the dominant narrative as you watch all these headlines roll in. See you next time.